Forget what you thought you knew about crypto being a market for the little guy. That era is fading. Right now, the world's biggest financial institutions are in the middle of a multi-trillion-dollar shift into digital assets. My analysis points to 2026 as the tipping point, the year the window of easy opportunity for retail investors could shrink for good. The evidence is hiding in plain sight, and in this video, I'm going to lay out the thesis for you based on compelling data and major shifts happening as we speak. And later in the video, I'm going to show you the part of this story that almost no one is talking about, the move that could literally lock regular investors out by 2026. This isn't a gradual change. It's a flash flood, and the dam broke in January 2024. That was the month the U.S. Securities and Exchange Commission finally approved the first U.S. spot Bitcoin ETFs. Before this, for a major institution to buy Bitcoin was a logistical nightmare. The ETF wrapper changed everything. It turned Bitcoin into something as easy to buy as a share of Apple, all inside the regulated and familiar world of the stock market. Instantly, giants like BlackRock and Fidelity had a product to offer their clients, unlocking a colossal pool of capital that had been stuck on the sidelines. Beat B, the hard numbers. But here's the part almost nobody sees. The impact was profound. In the year that followed, North America saw its on-chain crypto activity grow by 49%, with total transaction value reaching over $2.2 trillion between mid-2024 and mid-2025, reflecting this surge in institutional interest. Beat C, what institutions are actually signaling. The Bitcoin ETFs weren't just a product, they were a green light. They signaled that crypto was now a legitimate piece of the global financial system. But this was only step one. The ETFs were the catalyst, but the real accumulation, the great wealth transfer, kicked into high gear in late 2025. And what's unfolding right now shows that this 2026 thesis isn't just speculation. It's a structural shift that's already underway. So, where's the proof? It's not in whispers, it's in public filings, policy changes, and verifiable capital flows. The evidence of this institutional takeover is getting stronger every day. And this next number shocked me. A 2025 study from Coinbase and EY Parthenon found that 86% of institutional investors surveyed either have exposure to digital assets or plan to make allocations in 2025. Think about that. Nearly 9 out of 10 of the world's large money managers are signaling their move into this space. And the same study found that 59% of these institutions plan to allocate over 5% of their total assets to crypto. When we're talking about firms managing hundreds of billions or even trillions, a 5% allocation isn't a small bet. It's a strategic multi-billion-dollar shift. But it isn't just about Bitcoin anymore, and this is where the story flips. Institutions are building the sophisticated financial plumbing for the entire asset class. A huge part of this is stablecoins. Their transaction volumes have exploded, becoming a critical bridge for institutional liquidity. Major players like Visa and MasterCard have rolled out products for stablecoin payments, while banking titans are actively exploring their own solutions. This isn't theoretical. This is the construction of frictionless on-ramps and off-ramps for trillions of institutional dollars. But let's move from surveys and plumbing to the hard facts of the last few months. This is where the argument goes from probable to nearly inevitable, but that's not even the crazy part. First, the ETFs. Since their launch, the U.S. spot Bitcoin ETFs have become a black hole for supply. As of early December 2025, these funds collectively hold over $121 billion in assets. BlackRock's IBIT fund alone became the fastest ETF in history to reach $70 billion in assets, a milestone it crossed in just 341 days. To put that in perspective, US ETFs now control over 1.3 million Bitcoin. With a maximum supply of 21 million, that means over 6.2% of all Bitcoin that will ever exist is already sitting in Wall Street's regulated funds in less than 2 years. And now, for the recent bombshells. For years, the big wirehouses, the wealth management arms of the major banks, kept their thousands of financial advisors on a tight leash, forbidding them from proactively recommending crypto. That has just ended. In October 2025, Morgan Stanley issued new guidance recommending a 2% to 4% allocation to crypto for clients with a higher risk tolerance and framing Bitcoin as digital gold. Then, in early December 2025, Bank of America officially greenlit its roughly 15,000 wealth advisors across Merrill and the private bank to recommend a 1% to 4% crypto allocation to their clients. This isn't a passive nod. It is a formal shift from prohibiting advisors from recommending crypto to allowing them to actively suggest it. If those were cracks in the dam, the final wall just came tumbling down. And this is the part almost nobody sees. The industry's most famous holdout, Vanguard, manager of over $11 trillion for more than 50 million clients, had been famously anti-crypto. They blocked customers from buying the new Bitcoin ETFs, sparking a firestorm online. As of December 2nd, 2025, Vanguard completely reversed its stance. The firm announced it would now allow its millions of brokerage clients to buy and trade third-party crypto ETFs for assets like Bitcoin, Ethereum, and others. This is the final domino. While not every institution is on board, the momentum is undeniable. Every corner of Wall Street, from aggressive hedge funds to the most conservative asset managers, now has a regulated path and, in many cases, an explicit recommendation to move into digital assets. The great accumulation isn't a future event. It's happening right now. Right. If you're getting value from this analysis and want to stay ahead of these market-moving trends, do me a favor and hit that like button. It tells the YouTube algorithm that this is a critical briefing and helps get this information out to more people who need to see it. It takes 2 seconds, but it makes a huge difference. So what does all this mean? The institutions are here, so the party's over for the little guy, right? Not exactly. But it does mean the rules of the game have fundamentally changed. This next point might change how you invest forever. The primary implication is what we can call the great supply constriction. Bitcoin has a fixed supply of 21 million coins. Ethereum's supply, while not fixed, can become deflationary during periods of high network activity, meaning more ETH is destroyed than created. Unlike stocks or fiat currency, these core assets are defined by scarcity. When trillions of dollars of institutional capital, guided by recommendations of a 1 to 5% allocation, begin chasing a provably scarce asset, the laws of supply and demand take over. The Bitcoin being bought by these ETFs isn't going back into circulation on retail exchanges tomorrow. It's being held by custodians like Coinbase on behalf of the funds, earmarked for long-term allocation in retirement portfolios and trusts. Every share of an ETF that is bought is a piece of the underlying Bitcoin supply that is effectively taken off the easily accessible market. This institutional buying acts as a giant supply sink, constricting the amount of crypto available for the average person to buy on an exchange. And this is where the story flips for the average investor. This marks the end of an era, the era of asymmetric opportunity for retail. For the first decade of crypto's existence, the average person often had an edge. You could discover new projects before institutions even knew they existed. That asymmetry is collapsing as the market becomes more efficient. In finance, efficiency often translates to lower potential for explosive outsized returns. The market is rapidly shifting toward regulated Wall Street-style products. The Wild West volatility is being tamed and replaced with ETFs and other instruments that fit neatly into a traditional portfolio. On one hand, this brings legitimacy and a higher price floor. On the other, it introduces management fees and the loss of direct custody, the very essence of what made crypto revolutionary. As institutional liquidity deepens the market, the extreme volatility that created opportunities for 100 times gains will likely trend lower over time. The window to get in ahead of the institutions is closing. The game is shifting from discovery to accumulation. The new opportunity is about positioning yourself alongside them, building a meaningful position in the core, scarce assets before the bulk of their allocated capital has been deployed. So, why 2026? Why is that a potential tipping point? The date isn't arbitrary. It's a projection based on the acceleration of the trends we are witnessing right now. Institutional adoption isn't a straight line, it's exponential. Here's how to think about it. Phase 1 was 2020 to 2023. The pioneers, This was MicroStrategy putting Bitcoin on its balance sheet and a few brave hedge funds dipping their toes in. Phase 2 was 2024, the infrastructure. The launch of the US spot Bitcoin ETFs created the regulated bridges from traditional finance into the digital asset ecosystem. We are now in phase 3, which began in late 2025 and will likely run through 2026, the mainstream rollout. The recent announcements from Bank of America, Morgan Stanley, and especially Vanguard have opened the floodgates. This is the phase where a 1 to 4% crypto allocation shifts from a radical idea to a standard recommendation from an average financial advisor. This is where crypto gets integrated into the model portfolios that manage the retirement savings of tens of millions of people. But let's look at the math, because this next number is staggering. Vanguard alone has over $11 trillion in assets under management. If just 1% of that makes its way into crypto, that's $110 billion in new demand. Morgan Stanley's guidance could channel between $40 billion and $80 billion of new capital into the market. Bank of America's advisors are now armed with a similar mandate. We are talking about hundreds of billions, potentially trillions, of newly unlocked capital being directed toward an asset class whose entire market cap is just a few trillion dollars today. By 2026, it's plausible that this initial aggressive accumulation phase will be largely complete. The infrastructure will be fully built, the major players will have established their core positions, and a crypto allocation will be normalized. The low-hanging fruit will have been picked, the price of entry will be significantly higher, and much of the liquid, easily accessible supply of assets like Bitcoin will likely be consolidated within these institutional products. The year 2026 represents the plausible endpoint of the easy accumulation phase. After that, retail investors won't just be competing with each other, they'll be competing with the largest financial entities on the planet for an ever-dwindling supply of sovereign digital assets. This picture might seem bleak for the average investor. It might feel like you've missed the boat, but that's the wrong takeaway. The key takeaway is that the clock is ticking and your strategy needs to adapt. First, and most fundamentally, is the strategy of dollar cost averaging, DCA. The most defensible play in this environment is to accumulate systematically. You're not going to outtrade BlackRock's algorithms, but you can invest alongside them. By investing a fixed amount of money every week or month, you are mirroring the strategy of the institutions themselves, steady, dispassionate accumulation. But you still have one unique advantage over them, and it's critical you understand it. Self-custody. The institutions are buying Bitcoin, but they are holding it through intermediaries and charging fees. They are creating paper claims on Bitcoin. You have the ability to hold the actual asset. Taking your coins off an exchange and into a hardware wallet is you claiming your financial sovereignty. It eliminates the risk that an exchange goes under or a fund provider changes its terms. In a world where Wall Street is packaging crypto into products, holding your own keys is the ultimate power move. But here's the final piece of the playbook that will separate the winners from everyone else. Shift your mindset from pure speculation to education. Instead of chasing lottery tickets, use this time to learn. Understand the real innovation happening in areas like decentralized physical infrastructure networks or DePIN, a category that some market forecasts project could become a multi-trillion-dollar industry by 2028. Learn about what makes different blockchain projects valuable. The retail investors who succeed in this new era will be the ones who build genuine expertise, not the ones who just get lucky. The core thesis of this video is that the window for the average person to easily accumulate a stake in this asset class is closing. The evidence is compelling. The largest financial institutions are not just coming, they are here. They are deploying capital at an unprecedented rate, and my analysis suggests that by 2026, the landscape will be fundamentally reshaped. Now, this is not a message of despair. It is a message of urgency. The game is being won right now, but there are still moves left to make. The structural tailwind of institutional adoption is the most powerful force in this market, and for the next 12 to 24 months, you still have the chance to ride that wave instead of being swept away by it. The Wall Street era of crypto is here, and the clock is ticking. The decisions you make over the next year could determine your financial position for the next decade. If you want to stay ahead of these trends and get unfiltered analysis, on how to navigate this new world, make sure you subscribe and hit that notification bell. We're in the middle of one of the biggest financial shifts of our lifetime, and you don't want to miss what comes next.